Hello everyone, my name is Jiahao Zhang and I am assigned to evaluate Fortescue Metal Group Limited and make recommendations for General Electric on the attractiveness of FMG. I will firstly start with analyzing our firm, General Electric. Our firm is currently suffering from declining revenue and rising debt levels. We try to solve this problem by focusing on core business, such as aviation, power, and renewable businesses. Then, for target firm FMG, it is the fourth largest iron ore producer in the world. However, this industry is stagnant due to lower demand from steel industry. The significant price drop also makes FMG's revenue fell at 10.9 annually, which is larger than the industry average. Before calculations, there is one more question that needs answers. Will this acquisition benefit both companies? Well, for our company GE, it has global diversification and tax benefit. Our subsidiary GE Mining and GE Transportation can help FMG to reduce its costs. Then, let's go through my calculations. The first step is determining the cost of capital, so we can discount future value to present value. Cost of equity is estimated by CAPM with the chosen risk-free rate, market risk premium, and calculated beta. Cost of equity is 8.65%. In order to calculate the discount rate, WACC, other components need to be determined. Cost of debt is calculated by interest rate expense divided by total debt outstanding. With debt to equity ratio and FMG's effective tax rate, the calculated WACC is 8.12%. Both valuations are performed on FMG. For the fundamental valuation, DCF model using FCFF, which is free cash flow to firm, is chosen. Reasons are listed in the slides and more details in the report. I also use price to earning ratios for the relative valuation, and the company are chosen based on their market cap. Fundamental valuations. I list some assumptions. A detailed calculation process is shown in Table 1 in the report. By using two-stage model, the calculated intrinsic value is around $10, whereas the market price is 4.39. Therefore, the company is currently undervalued. For the relative valuation, it is very hard to find the comparable firm in the iron ore industry, so I expand the entire material mining industry in both Australia and US market. It makes the valuation method less accurate. FMG's estimated share price is $4.6. Then I perform sensitivity analysis on both fundamental and relative valuation. For DCF model, both assumptions do not have material impact on the conclusion that we made before. For relative valuation, the sensitivity analysis demonstrates the limitation of the valuation method. When evaluating synergy, I think cost reduction is more significant compared with revenue generation due to the stagnant iron ore market. The share price with synergy consideration is ranged between $11 to $13. When it comes to the question of is it truly attractive, I don't think so. Purely from statistical analysis, yes, shares are undervalued. And also FMG has much lower debt to equity ratio. GE can also improve its balance sheet. However, here is a big turning point. There are so many problems associated with this acquisition. Iron ore market is facing significant downturn. GE has problem with materializing synergies, and this acquisition is contradict to our company's strategic goal. Mining is not our core businesses, and we don't actually have the money. If we ignore my recommendations and proceed the acquisition anyway, the first thing we need to do is to find out the offering price. I would say 20% premium on the market price for 75% of FMG shares. The calculated exchange ratio is 3.31. We are trying to reduce our debt level and using cash for restructuring purpose. The best choice for us is to use all stock acquisition. We can use repurchase program shares for this acquisition. Totally, this acquisition was 8.75 billion in US dollars. Are there any regulations? Yes, this is subject to Foreign Investment Review Board. We need their approval to acquire more than 20% of FMG's shares. Then we can send bidder statement to FMG and they can return the target statement to us. By using the off-market bid, we are also subject to ASIC and takeover panels. We need to follow the Corporation Act and mitigate the possibility that takeover panel declare unacceptable circumstances. Detailed descriptions are shown in the report. Just after the trade war, a large US company acquired a company that has long-standing relationship with Chinese customer will raise some concerns, of course. One of the substantial shareholder of FMG is owned by Chinese government, may also hold back this acquisition. If FMG reject this offer and we try to acquire them, then it is subject to hostile takeover. Institutions own majority of FMG's shares. If they do not have positive expectations on our company, they may reject the offer. Of course, FMG can defend themselves by using white knight, poison pills, and etc. In general, target firm's share price will increase, but below the offer shares price due to market inefficiency. Target firm share price will fall. The changing amount will depend on the market participants' expectation after the acquisition and more detail in the report. In conclusion, based on the above analysis, I don't recommend this acquisition. If we still proceed this acquisition, then I would suggest a full stock acquisition with an exchange ratio of 3.01 and this was 8.75 billion US dollar. Thank you so much for your time.